For more, let's turn to CNBC contributor Loretta Mester, former president of the Cleveland Fed. Loretta, great to have you with us. Welcome to Fast Money.
Thanks for having me.
What should the Federal Reserve do next week?
Good question. I would be continuing on the path of reducing the interest rate. I would do 25. I would not do 50. But there's nothing in the data that came in that really changes the median run outlook, which is kind of what they aim for, right? You're trying to set policy to affect the economy, but it won't affect it today. It's going to affect it 8 months down the road. So you're trying to sort of all when the data comes in, it's like, well, where is the economy going? And where should we put policy to be calibrated with that? Also, you want to make sure that you don't get too far out of whack one way or the other if the economy doesn't perform the way you expect it to. So it's all about keeping the monetary policy in a good place to be able to respond to risks if they manifest themselves on either side, but really keeping it normalizing as the economy is normalized.
What's your take, though, on the move that we've seen in the 10-year Treasury yield versus what the Fed has actually done, which is cut by 50 basis points in September, but the 10-year yield has actually been up by about 60 basis points since then?
So I think a couple of things. One, I think, the economy, the data has come in pretty strong. I mean, you mentioned that the third quarter report was a little weaker than expected, but it's still a well above trend growth rate of the economy, and people earlier in the year wouldn't have expected by this point that we'd be still above trend on growth. The healthy labor market conditions, right? There was a scare that things were actually deteriorating more than the Fed would like to see, and I think that prompted a 50 basis point cut. But those numbers have come in pretty good. We'll get another read on Friday, as you know, and that'll give more insights into that, although noisy data because of Boeing strike and the hurricanes. So you have to take that with a little bit of a look through noise to signal. But still, I think the economy is doing really well, and productivity growth has been remarkably good. So I think all of that that's feeding into where the markets, are putting the long rate. And then on the other hand, there's a lot of talk about deficits. And, that could lead to higher nominal long rates because of both the inflation that would be embedded in that and also, in terms of having to induce people to hold those treasuries.
So how do you think about that? I mean, I know, there's fiscal policy and monetary policy, and you can only do what you can do. But you're on the Fed. There's this clearly growing problem that will one day burst. How do you factor that in?
So I think firstly, there's going to be a change in government or not, right, depending on what happens, right? So we're going to have a new administration, right, and they're going to be setting fiscal policy, but we're not going to know much about that until, next year sometime. So at some point, the staff of the Fed will be embedding sort of assumptions about fiscal policy into the models. So it gets taken into account when you're thinking about, monetary policy. In terms of the long run issue about financial markets, I mean, part of what the Fed does all the time is sort of monitor conditions in financial markets. So it is attuned to those issues. But I think, part of the problem with the deficit problem, the debt problem, is it's a serious problem. But it hasn't really affected things in a negative way so far. And it's one of these things, until you see the bond market reacting, I don't know whether there's any will to address that issue. So you really can't take into account and set your monetary policy assuming that at some point there will be a reaction in the bond market. I think that's one of those things where it's part of the milieu that you're working in. You have to be ready for it, right, and be able to know how to react if it happens. But you can't really take into account in your setting day-to-day monetary policy.